The national portion of the life insurance exam frequently tests your understanding of the basics and purpose of annuities, which are contracts specifically designed to protect against longevity risk. Longevity risk is the technical term for the possibility of a person outliving their financial resources, and this is the primary problem an annuity is designed to solve. While life insurance, an annuitant is the person whose life expectancy determines the payout amounts. On the exam, they might try to trick you by suggesting that annuities are primarily for wealth accumulation, like a standard savings account, but their core purpose is the systematic liquidation of a sum of money to provide income. Another critical area for the exam is tax-deferred growth. During the accumulation phase, the money inside the annuity grows without being taxed every year. You are only taxed when you start taking the money out, and even then you are only taxed on the earnings and not the principal that you contributed with after-tax dollars. This is a huge selling point and a frequent focus of exam questions regarding the benefits of annuities for retirement planning. Let us look at a concrete exam-style example. Imagine a client named Sarah who is concerned that her $60,000 in savings will run out if she lives past age 90. If she purchases a straight life annuity, the insurance company promises to pay her a monthly check for as long as she is alive, regardless of whether she lives to be 90 or 110. The insurance company takes on the risk that she might live a very long time, while Sarah gains peace of mind. Watch out for trick wording regarding the parties to the contract. The owner is the person who pays the premiums and has the rights to the contract, such as changing the beneficiary. The annuitant is the person who receives the payments and whose life expectancy the insurance company uses to calculate those payments. Usually, the owner and the annuitant are the same person, but they do not have to be. The beneficiary is the person who receives any remaining value if the owner or annuitant dies during the accumulation phase. One common trap on the exam is a question asking who the insurance company bases the payout on. They will list the owner, the beneficiary, and the annuitant. The answer is always the annuitant. To help you remember the difference between life insurance and annuities, use the phrase, life insurance pays if you leave, and annuities pay if you live. Think of life insurance as an exit strategy and annuities as a living strategy. When you are looking at questions about the purpose of annuities, keep an eye out for phrases like guaranteed lifetime income or protection against outliving one assets. If a question asks about the primary risk associated with annuities, it is longevity risk. If it asks about the tax status during the accumulation period, the answer is tax-deferred. Understanding these distinctions will help you navigate the nuances of annuity questions on the national exam and ensure you do not get tripped up by the similarities between various insurance products. Focus on the fact that an annuity is a contract between an individual and an insurance company designed to provide a steady stream of income that cannot be outlived. There is also a distinction between the accumulation phase and the annuitization phase. In the accumulation phase, you are putting money in and the value is growing. In the annuitization phase, the contract is triggered and the money starts flowing back to the annuitant. You cannot do both at the same time. The exam might ask about the transition between these two phases, so keep in mind that once a contract is annuitized, the owner generally loses access to the lump sum in exchange for the guaranteed income stream.